do you still own single family properties?
Yeah, good question. I mean, a lot of our clients kind of are going through this stage, right? They are already an accredited investor and they might have owned several rental properties. And it's the idea of unwinding this. I myself had 11 and it was kind of a pain. And I wish I didn't have bought so many. But what I did, I mean, first thing I always do is I always test something and then I, see how it goes. And then I move in pretty confidently. Looking back when I was going into single family homes, out of state, right? Out of Seattle, where I didn't feel it, touch it, didn't really see it. I bought one and the thing worked. And then I just moved my entire portfolio into that stuff.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable, real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins.
What's that make you think? And where are you at in your journey building wealth, building that pathway to financial freedom? Today's conversation is amazing. And I know we touch on a lot of different points, but coming from a different perspective of how we're going to take this elevator from all the way from whether you're in the basement or you're an accredited investor, whether you're an accidental landlord, whether you're focused in single family, doing syndications. Well, there's a path laid out in this book called The Wealth Elevator, where we can leverage these tax advantages of different kinds of investments to keep that journey going, maybe even get you there faster. Today's guest started his professional career as a professional engineer. So working that W-2, had 11 single family units and made this pivot into syndications, now controlling more than 2 billion. Yes, 2 billion. And that's somewhere around 10,000 plus units. You could say he's got a pretty good grasp on the market, the cycles, and what it takes to not only build wealth, maintain wealth, but just launch yourself into a whole new platform. Everybody, please welcome Lane Kawaoka to the show. Lane, welcome to the show, man. How does it feel to be Lane today? You're telling me it's a little like Christmas morning this morning, huh?
Yeah, it's recording this in mid-September. Supposedly the Fed is finally supposed to drop rates. Everybody thought it was going to be in July, but I think the Fed is taking more of a approach where they take a look at the inflation numbers and unemployment numbers, and right now it's kind of touching 2.5, which is where it's been for quite a while now. But I think unemployment is kind of popping its head up. Getting into that 100,000 a month job creation. So I think it's finally time that the Fed is looking to give up some of that dry powder is the way I look at it. Dry powder in terms of ways of stimulating the economy. So it's time to start doing it. And as real estate investors, a big part of real estate is getting interest in good loans, and interest rates is a huge part of it. Some would say even 60-70% correlated with that.
Mm-hmm. Yeah, it's crazy, and how those cycles go through and how one thing affects another thing. Very interesting to see. But before we get into all of that, Lane, let the listeners know a little bit about who you are and where you're at now.
Yeah. So we own a control a portfolio of over $2 billion of assets, mostly multifamily. We do a little bit of value add, cosmetic renovations. We do ground up development, and now we're getting into more private equity projects, buying businesses. But that it's been at least a decade in the making. I started my career as an engineer. In 2007, I graduated college, saved up my money to buy a house to live in because that's what I was all taught to do. Right? We're all kind of brainwashed in a way to invest in traditional investments and buy a house to live in. And that's what I did in 2009. But because I was traveling all over for work for my construction engineering job at the time, I just rented it out because I was a young single dude back then. And I just started to, that was the start of it all. Started to realize, wow, this is cool. Getting this cash flow, tax benefits and everything.
And that, I believe that was in Seattle, right? So the first house comes in Seattle. Your W-2 working as a professional engineer. And I see on your website, thewealthelevator.com, that kind of grew into a few more single families. Is that was your first token? I mean, you saw what that did when you rented out your house and you wanted more of that?
Yeah, I mean, there's a lot of these like multifamily gurus that teach this type of stuff, which they say you can go from nothing to large apartments, which I would totally disagree with that. I mean, I bought that first rental property was a Class A rental in Seattle, which not necessarily good for, investing, right? Class A rentals are a little more luxury, more nicer.
Expensive.
The main thing is you don't hit the rent to value ratios. Normally, you're trying to be around that 1% rent to value ratio, where you take the monthly rental price divided by the purchase price and be close to that 1%. That first one, and mind you, this is when the prices were amazing back then, post Great Recession in 2009. I think the rents were like 2,500, and the purchase price was 350,000.
Oh, wow.
So if you do the math, that's well below 1%. So, but I was like, wow, I didn't know anything about like rent to value ratios or how to underwrite deals. We got like a free analyzer. People want to go download it on my website to kind of play around with the numbers, but I didn't know any of this. But it just, for me, it worked back then, right? And it allowed me to like get started. And I went and bought a duplex in Seattle that was more of a B class rental property. I think that one rented for 2,100 a month. That was a little bit cheaper, 250,000. It's a little bit better to that rent to value ratio, 1%. But at this point in 2012, when I had a few units, the prices start to go up, right? Which is, we're kind of in that vicinity now in commercial real estate today, right? Commercial real estate came down quite a bit, 20-30% over the last couple of years. But I caught this wave back in 2012, and I started to buy rental properties out of state. And around 2015, I had a portfolio of 11 of these single family home turnkey rentals, Birmingham, Atlanta, Indianapolis, in these more flyover states. And that was kind of the mid years, right? Or the adolescent years of, rental property ownership, I would call it.
Mm-hmm. And what was the big change for you, Lane, then to go from, that single family world into the scaling piece? And I heard you say that it was a good foundation builder. The single family was kind of learning. Is that how you felt?
Yeah, I mean, I talk about this in my book, The Wealth Elevators. There's different floors to the wealth building journey. When I first started, I wasn't broke, right? Like I think most of the books out there, Dave Ramsey, Susie Orman, Rich Dad Poor Dad, they're all kind of written for lower net worth investors, which in my book we call the basement, right? People less than $250,000 net worth, or they make under $50,000 a year, right? Me as an engineer, I mean, engineers don't get paid that great, but I was making around six figures, and I was really good with my money. More importantly, most of the investors we interact with today save $50,000, $100,000 a year at least. Some of them spend a lot of money. Some of them really frugal, like myself. But at the end of the day, it's not what you make; it's more what you save in net and invest. At the end of the day, but from 2007 when I graduated to about 2015, 16, I want to say, is when I was going from $0 net worth to $1 million net worth, which is kind of a key indicator in terms of being now an accredited investor per the eyes of SEC. Now, you may make more than $200,000 a year, and that will qualify you as an accredited investor. But at this point, what I realize, single family homes are cool. And a lot of people, they talk about doing this buy rent rehab strategy with single family homes. But most times what I started to realize, and I started to realize this by interacting with other purely passive accredited investors, just haphazardly. I started to meet a few, started to go to some conferences, and I started to realize there was sort of a kind of hidden culture, hidden ecosystem of accredited investors kind of doing it this way, right? Where they were trading in their rental properties and going into syndications and private placements as a passive investor. And then also now branching off into, real estate and other asset classes. More importantly, throughout this next rung or this next floor of the wealth elevator, which we define as floor 2 and 3, you know, activating all these cool tax strategies, right, that go well beyond your 401k and Roth IRA and backdoor Roths and what, people in the fire community think is sort of cutting edge, right? A lot of these, when you combo the depreciation that you get from real estate and cost segregations that you can get in larger deals, in syndications, now you're really cooking with this stuff. And at the end of the day, your net worth is growing with a lot less drag, and that drag being taxes.
Yeah. So that change then entering into what sounded like the syndication world from the single family world. Did you then, what did that transition look like for you? Did you get rid of all 11 properties right away, or was it something that timed out, or do you still own single family properties?
Yeah, good question. I mean, a lot of our clients kind of are going through this stage, right? They are already an accredited investor and they might have owned several rental properties. And it's the idea of unwinding this. I myself had 11 and it was kind of a pain. And I wish I didn't have bought so many. But what I did, I mean, first thing I always do is I always test something and then I, see how it goes. And then I move in pretty confidently. Looking back when I was going into single family homes, out of state, right, out of Seattle, where I didn't feel it, touch it, didn't really see it. I bought one and the thing worked. And then I just moved my entire portfolio into that stuff and had 11. So same thing here. I was like, all right, I'm going to just do this again, right? It's another step. I've been here before, getting in out of my comfort zone. So I went into a few deals as a passive investor, and then also got involved on the general partnership side because I was just maybe I just was really not really trusting that I wanted to have a seat inside the cockpit, as they say, right? Sometimes they use the analogy for these syndications as airplanes, where the general partners are in the cockpit flying the airplane, and then the passive investors are in coach, putting in the money, and then everybody's in the same venture. And then if the plane goes down, the general partners have skin in the game. They go down with the airplane too. So I wanted to kind of be up there just for my own good. And, had some early success, had some, we can talk about some of the issues in this world, like work with some bad partners. But I was like, yeah, this makes sense, right? Like we're going into value add projects. There are things that we're doing to the property, or today we build from the ground up and create tremendous value add. Whereas when I was buying little single family homes, yeah, I was getting 30-year mortgages and it was cash flowing. And at that time, interest rates were low, but it was really at the end of the day, a buy, hold and pray strategy, right? There was nothing I was doing to that asset to improve the value, force appreciate the value specifically, like these larger deals was. And the tax benefits were stronger because of cost segregations and be able to aggressively depreciate the asset much faster than a 27-year-long depreciation cycle with single family homes. So I was like, yeah, this is the way I want to do things. So I started I think 2017, I started to sell off. I burned through all my cash, right? So I went to the few deals, which was, I think, great because I was able to compile passive activity losses, right? Because a lot of times in these deals, you aggressively get the losses in the beginning. So I was able to pool this on my, if you guys don't know where you find this on your taxes, you go to your 8582 form and there should be your suspended passive losses you have there. And we say it's suspended because think of it as up in the cloud, right? When you have capital gains or depreciation recapture, you can go ahead and access these. So I had been investing and I was able to accumulate these passive losses there, so that when I did sell my properties in 2017, I was able to use that. So in 2017, I started to, use, there's a website out there that a lot of newer investors will like to use, newer because there's always kind of a sucker born every day and you want to just unload your property to them. If people want to, know what that website is, they can reach out to me. But I think it's a great option for people unloading their rental properties, especially those that are being occupied by a tenant, because you're not selling it to retail homeowners out there. You're selling it to other wannabe landlords out there, and you're trying to you don't have to kick out the tenant, right? You can just buy it, so you don't have to cut your income stream. So that's what I did for these properties. And that first year, like I said, I had a pretty nice capital gain, and I also had to recapture the depreciation I took. So I think it was like I had $250,000 of that. So normally you have to pay taxes on that, but I had invested in syndications of private placements prior to. So this is a move unofficially called the lazy 1031 exchange. I think it's because, effectively you use the losses to offset your gains, but it's without the whole cumbersome 1031 45-day nonsense, pay a
So
custodian.
you're calling that depreciation, the loss in the syndications that you had basically piled up, you use that to offset the capital gains of when you sold your rentals, and that's what you're calling the lazy 1031, because you don't have to that time frame, whether it's 45 days before or 90 days before, 90 days after. You don't, an attorney like doing all this stuff. This lazy 1031 is taking these steps, what sound like the wealth building steps, where you've got these single families, and then you go into syndications, building up that depreciation from those cost segs, and then selling the single families, using those active losses to offset the depreciation recapture.
Thanks for reiterating that. It's a little confusing, and obviously I'm pretty passionate about this, right? Because it's something that I do, and a lot of other folks do out there. Obviously not a CPA or tax attorney. If people want a referral to a good one, they can let me know. But yeah, it's kind of like the old Indiana Jones swapping out the ark for the sandbag thing, right? So like the way I did it is like I had gotten the losses the year before, and then I went and did the swap in a way. You can also do it in the same year, right? Like, but I think that's a little ballsy, especially if you're looking at a huge capital gain of several $100,000 and above. Just like, goodness, if you have money, you have some money to invest in the deals first to kind of prime the pump, I would say. But you don't need to get any like attorney involved or custodian like a 1031 exchange. That's why it's kind of called the lazy 1031 exchange. When you invest, especially in real estate, you get passive losses, right, from the depreciation. And if you invest in deals where they're doing a cost segregation, you get a boatload of these losses, often more than you can use. So if you don't use it, it becomes suspended on that 8582 form, and you can use it for subsequent years or that year. So there's a little bit of planning on this, right? Like I was just talking to a client the other day. They had a pretty large property, $1 million property that they bought when it was almost nothing. So at least $500,000 capital gain there, which is great, right? That's where you want to be. But if you sell that, you want to have that passive losses to offset that, so you don't pay the taxes on it. And this is kind of where I think, what I realized, there was a lot of investors doing it the wrong way, right? That said, they're doing amazing, right? And I think this is why real estate investing is so cool, because you can have a pretty bad strategy and you can still do pretty well, right? Mm-hmm. Doing this type of stuff. But one of the mistakes they make is like pay down their properties all the way, right? Because it's not really return on investment. It's more of a return on equity standpoint. As your properties appreciate in value, you have more equity. And at the end of the day, return on equity, the math equation is how much money you're making divided by how much deployable equity you have locked up in that deal. So a lot of, old school landlords say pay down the properties at some point, which we'll get there, I guess. But, if your property is paid off, you're not making very much money, probably in the single digits. And I would argue, for that much headache and legal liability, you want to just get yourself in T-bills, for goodness sake, right? And that was a big thing when I started to interact with these accredited investors. It was, we want to grow our net worth, and that's why we're going into value add deals and kind of re-leveraging our money into that. But it was also a liability standpoint, right? When you talk with guys under $1 million net worth, they don't really have anything to lose, right? Doctors, dentists, high net worth individuals, you got something to lose. You got a big target on your back. And when you own little rental properties, it's a huge liability owning that. Slips, trips, or falls, somebody commits suicide and then they blame you for it. Like this is why it's the transition to being a passive investor where your limited partner is kind of the more transition, the way what I saw. A lot of this, like I thought rental properties was the way to financial freedom and is part of the way. But at some point there's a pivot point, and this is kind of where I brought into my book this wealth elevator system, where at some point, some threshold, and I would probably say once you're an accredited investor, you kind of get out of direct property ownership and transition to syndications and private placements on the second and third floor of the wealth elevator. But going to taxes again, like this is like who talks about this type of stuff, right?
Yeah.
A lot of times
outside of the investor world, even the outer rings of the investor world, nobody talks about it. Right. The first times that I heard it was like, wow. And you keep mentioning cost segregation. Just in case any of the listeners don't know, cost segregation is a study particularly performed by a professional engineer, right, that goes through and analyzes certain materials inside of a structure. And each type of material has a different lifespan than the other one. And CPAs are able to accelerate the depreciation based on these different lifespans. And it gives you the ability to push or front load a lot of that loss up front. And it brings on massive help when we're looking at offsetting our passive income. If we've got these properties, Lane, that, and something I've heard recently, and I've heard it murmured before in the political world, but being taxed on unrealized gain, what do you think about that?
I don't think it'll ever happen. I mean, it's super, super messed up if you kind of think about it, right? Like since
Just
sort
really
of
messed up.
Yeah. I mean, like I may look young, but I've been through quite a bit and I see all kinds of like knee jerk kind of clickbaity type of things like this pop up. Like they're going to get rid of bonus depreciation.
Mm-hmm.
What was the other one? They're going to get rid of Roth IRAs. And that's why solo 401ks are a little bit more superior. Like this stuff never really comes to fruition, especially more extremist things like this. And I myself tried not to be political. I frankly don't care who wins. Statistically, it doesn't really matter. And that's why, part of it is I don't own any stocks too. I don't own any traditional investments. Everything I own is harder assets that at the end of the day, I like it because my feeling is I control my own destiny, right? It's income minus expenses on what my asset performs at. And that's where I feel like I'm more in control, or maybe that's part of it, like why I don't give a rip what's happening out there in the news,
right,
other than interest rates, of course, right? But, it, like they always talk about, taxing this or that. At the end of the day, the smart people, there's a saying, money talks, right? And that's the TikTokers out there, the young guys buying and flipping houses, but wealth whispers. And when you become an accredited investor, it's important to find a community of like-minded accredited investors flocking in the same direction, because very quietly, like there was another thing that they were going to tax the ultra wealthy, right? But then they correlate it with taxing your income. Dude, guys, it's not about your income, or it's not about your net worth. It's about they're taxing income. So get smart and lower your adjusted gross income. And these are the sort of the strategies that people use. They have all their money as passive income so that they can use these passive losses to get it down to nothing. Now, a lot of folks starting out, a lot of new clients that I have, they have a problem of high ordinary income. The problem with ordinary income is you can't use passive losses to negate it. But you could possibly do real estate professional status as another option, right, to lower it, right? So that's just an example of the things they put in the news. Sometimes I see right through it, right? Or people in our world. It's that's not really impacting us because we're smart. We'll just lower our AGI legally, totally legal. And that we'll fly on the radar and we won't get hit with these tax rates for the millionaires, even though we are.
Yep.
But yeah, I try to invest in things that are a little bit more like long-term vision, right? Like multifamily, workforce housing. I think the people are becoming, there's a dichotomy, right, between the rich and the poor. I think myself growing up in a middle class family, that's becoming an endangered species. And those people, if I didn't do something that changed my trajectory, we would be living in apartments that I own these days, right? These value apartments, where you rent it out for $1,000, $1,500 a month. Like, I think that's the trend in the future. And I'm going to kind of stake my portfolio on these trends that the average American uses.
Mm-hmm. And you mentioned REP, that real estate professional status, and that's a way. Again, I'm not a CPA, you're not a CPA. It's so funny that we have to use these disclosures or disclaimers. Anyway, what that does is allows you to change buckets, the active bucket, passive bucket. With the REP status, you can use passive losses to offset your active income. And when you're talking about reducing your AGI, that's the way to kind of cross paths. Some people, it's difficult when you're working a W-2. I mean, even if you leverage certain ways or like a short-term kind of direction to get there, it can be difficult if you're full-time working somewhere else. We are blessed with the ability I mean, we live, eat, breathe, sleep real estate, and it's easier for us to hit that REP status. Ultimately, wanting to shift all of your income into the passive bucket anyway, so you don't have to be a real estate professional anymore. You just got passive income, so you can use your passive losses to offset that. Lane, when you say cash flow investing and appreciation investing, and I see it kind of in quotations, for example, gambling versus speculating, what in the world do you mean by that?
Yeah, I mean, I think what I'm talking about there is, when I first started, I started to invest for cash flow, right?
Mm-hmm.
Because I was working my engineering job that I did not like, and I want to get out of it as soon as possible. So how do you fix that? Well, you go into investments that give you cash flow so you can replace your income. I think this is, everybody talks about this, the cash flow is king, whatever, right? But at the time, what I didn't realize, and again, there's a lot of the stuff that I write in my book that I've learned from higher net worth investors, right? Guys over 5-10 million and above, is that, initially, you go after cash flow because it essentially is kind of that reaffirming thing month after month, quarter after quarter, that you made the right decision. But in reality, what you should be doing is sort of the opposite. You should be going into deals that give you bigger whacks of equity growth and appreciation. And as we would all assume, you have to do a lot more of delayed gratification in that. The reason being is, I mean, a lot of these high net worth families, think about it, right? They either have jobs, right? A lot of people still work out there. That's your cash flow. That's your huge advantage, still having a paycheck. It allows you to invest, not needing the cash flow today. So go with it, right? And that's where you can invest for bigger growth in the future. What you people have to realize is a lot of the investments that you want to be going into, especially if your net worth isn't to $5-10 million yet, are going to require, value add. You got to bake the bread in the oven. You got to wait for the bread to be finished, right? It's none of this like put it in, put it out, like kind of stock market stuff or short term, more dividend type of investments where you get instant liquidity. There's a saying out there, like, like Buddha says, you can't ride two horses at one time. You cannot get cash flow and equity appreciation at the same time. It's either one or the other. If you can find a guy who's super fast like LeBron James, that's 7'7", let me know. But either way, they're unicorns, not out there, right? If you can find, like, it's essentially like an investment that you could double, triple your money in a few years, and you can get cash flow along the way. Frick, sign me up, right? But you don't have those. It's either one or the other, or combinations of thereon in the middle. So that would be what I would caution folks. I mean, that said, a lot of people, new investors will gravitate to more cash flow things, but I would end with there's a little bit of a false sense of safety with that, right? Yeah, you're getting your initial capital back sooner rather than later, and you're getting that confirmation, right? And also, your wife is like, "What the heck did you do with the $100,000?"
Yeah.
Oh, we got this $50 every month, from it, or every quarter. Like, even though that's insignificant, what you have to realize is in these types of projects where there's cash flow, the amount of value add that you're doing is much less, right? So like this is why we started to develop and now going after businesses to buy. When we first started, we buy, 50 unit, 200 unit apartment complexes and did the old value add strategy, which essentially isn't huge. It's just cosmetic renovation, new flooring, new appliances, new paint job. It might be $5,000 per unit. It might be $15,000 per unit in a high price area like Phoenix. But essentially, it's lipstick on a pig, right?
Mhm.
All you're trying to do in those types of projects is bump the net operating income by 10 to 20%, which in commercial real estate, when you divide it by the cap rate, is how you make big returns,
Mhm.
right? But when the market corrects 20%, 30%, you're still underwater, especially if you haven't implemented the majority of your business plan. So
Mhm.
that's where you're somewhat exposed by going after the cash flow plays, right? And a lot of this is, just lessons learned from myself. I mean, one way you can, protect against this is diversifying over 4 to 7 years, right? So that your beginning part of your portfolio is intact when a market cycle does happen. But this is obviously fresh in our mind right now. Commercial real estate went down much more than it did in 2008, 2009. Not a lot of people talk about it. And it's an amazing time. Like I'm picking up properties, looking at a deal for 110 a unit. That's how we distill it down, right? Quickly in a nutshell, we break it down price per unit.
Is that
Whereas the
like
same,
class B? Class B
it's
110?
yeah, I mean it's actually class A minus, built
Oh wow.
2020. Yeah. So it's pretty
Wow.
new. Where I was buying, crap that was built 1980s for the same price a
Oh
couple
wow.
of years ago,
Yeah.
or worse. And that's just the signs of the times, right? At the end of the day, it is somewhat timing your entry point. Right now is probably one of the best times to time it.
Mhm.
Especially as the Fed has signaled multiple rate cuts in the future. Like this is the time, folks, right?
Yeah.
But this is also the time, as Warren Buffett says, when times are fearful like now, this is when the real investors come out.
So rates went up, and that challenged things, especially when people were, in this turning of these loans, whether they're 3 year, 5 year, or whatever, it can't make the numbers work at rates. But as now they're targeting to come down, so pricing goes down when rates go up, right? Is that how that?
Yeah, you're exactly right. Maybe I'll give an example because like we haven't bought a significant purchase since the summer of 2022 when interest rates started to get
Yeah.
jacked up. The reason being like, Lane, why did you sit on your butt, not do anything, not buy anything? Well, because like my holding costs went way up, right? People understand this, right? Just like with the mortgages and residential real estate. But the problem with so I didn't nothing penciled, right? I
Mhm.
mean, unless we can hit a certain threshold of returns, or margin of safety, like we're not going to buy it. But what has happened in the last 18 months, certainly a year, is the prices have come down to a certain point that with even the high interest rates and high holding costs, the numbers make sense because the basis is a lot better. And
Mhm.
part of that is obviously supply and demand. Like you just using myself an example as a buyer, I stepped out of the market. I'm not buying anymore. Screw that. And
Mhm.
everybody else did that. That's why market transaction value went down to a fraction of what it was in 2021. And this is why in commercial real estate, the prices came down so drastically. Now, in residential real estate, I think something what everybody fixates on, incredibly different story there that I don't really not super interested in that world. But essentially
Mhm.
what has happened is that there's low supply. Even though the demand is, who knows where that is because it's low supply, that prices have stayed high there. But in commercial real estate, you have a little bit different, loans are a little bit different out there. You don't have 30-year mortgages. Things are ran on a quicker timetable. So you have people, buying properties at the peak and then their loan resetting a year, 2, 3 years from now. And that's what's creating distress in the market too.
Yep.
So what I would say for people reading the Wall Street Journal headlines is detach yourself. The deals with the higher bases bought at the peaks from 2020 to 2023, they may be just screwed, but it's not indicative of the entire market health, right?
Right.
Detach yourself from that. Unfortunately, the new deals that are going in, because again, it comes down to the basis, what you bought the dang property at. is really all that really matters here, right? If you're entering the asset at a certain price, then that's all that you kind of lock that in, where it doesn't matter how well you pull through these properties that were just bought at the peaks, because the basis is just too damn high on those.
Yeah. So all of this stuff, and I mentioned the elevator or the wealthelevator.com, and there's resources on there, but I wanted to direct everybody to the book too. First of all, or second, third, wherever we're at in this piece, awesome job, man. Congratulations on the book. I know that journey and it is quite the feat. So congratulations on that with this book. And it's called The Wealth Elevator, and they can find it on Amazon, right? Is that the best place to go?
Yeah, they got the monopoly on that book thing. Yeah, the Wealth Elevator. I think the cool thing in the book is, like, I'm an engineer, so I like tables and charts. So like there's like, based on your net worth, where do you fall, and what you should be doing for your alternative investments, and then investing mindset strategy, and then also get into like what you do for retirement accounts and life insurance and things like that based on where you're at.
Very cool. So have the listeners go out and get that. Did you do that on Audible, if there's that much visible stuff in the book?
Yeah, I read it out aloud, and then
Nice.
I think we have like a media page, the hidden page for people to download the visuals. But
Nice.
yeah, if people go out and pick it up, they can just email us for those the tables and charts,
Nice.
and we can get that sent to them.
My last question for you, Lane, is if you could go back, say, let's see, I'm going to go 15 years. So that would put us around 2010. With the knowledge that you have now, and go back 15 years and sat beside somebody who may have been on a similar path as you at that point. You were probably, what? Were you in college then, or where was that?
Well, I was probably 24, been working
Just
for several years, and
okay.
So at that time, probably, this is post recession, right? So I was just happy to have a job and not being unemployed.
If you could go back with the knowledge that you have now, the experience that you have now, and set beside somebody who was probably on the same path as you, whether it's straight W-2 income, happy to have a job, kind of living that life, what would you tell that person?
I would probably tell myself, at that time I made some bad decisions. Like I turned my mortgage on my at that time a few rental properties down to a 15-year mortgage because some bonehead told me to do that. So I've probably slapped myself and say don't do that. But at looking back, I mean I did it the right way. Like part of this is like wealth accumulation, the incubation stage. Like unless you're an accredited investor making $200,000 a year, I don't think you belong in investing in syndications and private placements. And I was probably, at that time I wasn't there personally. So I was doing probably the best thing at the time. I probably wouldn't have gone bonkers and bought, more than 4 or 5 of those turnkey rentals because it was rather a pain to sell them all. And I would have transitioned quicker to value add apartments or private equity. But, I think if anything, I would go back and just give myself encouragement because at that time my inflection point happened in 2016 when I started to find other passive investors and started to validate what I was doing, or at least pivoted away from single family homes. Because I think that's why I'm big on communities, and a lot of things that we do within our group are big on, like, we do retreats because it's so hard to meet other purely passive accredited investors, right? Like, speaking for myself, a lot of my friends and family don't do anything what I do. And this is a huge hobby to myself and people in our world that it gets a little lonely out there, walking the path of financial freedom, the fast path of financial freedom, right? As they call it.
Yeah. Yeah. Hey, that's great. And kind of like just doubling down on that. And it brings us back to the book and all your experience that you put in the book. So definitely going to be a great read there. Thank you for your time coming to us all the way from Hawaii. A little different on almost the other side of the world from us. But hey, man, I really appreciate your time, Lane, and appreciate all the experience that you've shared with us here today.
Yeah, thanks for having me, Brett.
Awesome.
Hello, everybody.
Yes, sir. Yes, sir. And to the listeners out there today, thank you as always. Thank you for your attention that you've provided us today. This is going to be a great book, thewealthelevator.com. Give that some of your attention because what we're talking about here today makes complete sense to me. how, especially, I know a lot of people start out, even in the accidental landlord world, how we can take those capital gains and kind of knock them back using the depreciation from syndications. I think it's just a great way to do this lazy 1031 process. So just great stuff and much, much more in the book. Go find the book, The Wealth Elevator. And until next time, this is the Real Estate Mogul MD.